Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what's going on, news related, see what people are talking about. Obviously, I'll give my financial opinions around it. And if you guys want to follow me, you can follow me at finding-value.com. Become a platinum member, use the word discount in the coupon code. And you can see what my portfolio is. You can see the changes I'm making, if I'm making any. I don't really sell too much. I usually just accumulate and buy for the bull market that is coming. But we do talk about a lot of different stocks, especially during the platinum question and answer sessions that we hold. So let's dive in here. Again, if you want to follow me, it's at finding_finance on Twitter. We're going to start with Stan Druckenmiller. He's one of the world's greatest money managers and has traded through market cycles for more than 30 years. In 2015, he gave what is now a timeless discussion about markets and processes at the Lost Tree Club. Here are 7 takeaways from his speech. So number 1, Druck attests that he's not a genius. He was not in the top percentile at school. Instead, he believes that he made his success from 3 things: passion for business, great mentorship, and risk management. It says number 1, had incredible passion, still does, for the business. The second thing, I would say he had 2 great mentors that he had. And the third thing was, I'd say, as I developed partly through dumb luck, I'll get into that, a very unique risk management system. The first thing I heard when I got in the business, not from a mentor, was bulls make money, bears make money, the pigs get slaughtered. I'm here to tell you I was a pig. And I strongly believe the only way to make long-term returns in our business that are superior is by being a pig. I think diversification and all the stuff they're teaching at business school today is probably the most misguided concept everywhere. And I wanted to cover that because he does go over that again here soon. He says, the mistake I'd say 98% of money managers and individuals make is they feel like they've got to be playing in a bunch of stuff. And if you really see it, put all your eggs in one basket and then watch that basket very carefully. So coming in here, he says they see something, they bet it, and they bet the ranch on it. And that's the kind of way my philosophy evolved, which was, if you see only maybe 1 or 2 times a year, do you see something that really, really excites you? And if you look at what excites you, and then you look down the road, your record on those particular transactions is far superior to everything else. But the mistake I'd say 98% of money managers and individuals make is they feel like they've got to be playing in a bunch of stuff. And if you really see it, put all your eggs in one basket and then watch the basket very carefully. At least that's his opinion. Number 3, he says, 1, his mentors taught him 2 crucial things. Never invest in the present. Look 18 months out. The central bank moves the market, not earnings. I've talked about this a lot as well. I call that market conditions or the business cycle. The business cycle is the central bank moves. It says if you invest in the present, you're going to get run over. It says he taught me 2 things. Never, ever invest in the present. It doesn't matter what a company's earning, what they have earned. He taught me that you have to visualize the situation 18 months from now. And whatever that is, that's where the price will be, not where it is today. And too many people tend to look at the present. Oh, this is a great company. They've done this, or the central bank is doing all the right things. But you have to look to the future. If you invest in the present, you're going to get run over. The other thing he taught me is earnings don't move the overall market. It's the Federal Reserve Board. And whatever I do, focus on the central banks and focus on the movement of liquidity. That most people in the market are looking for earnings and conventional measures. It's liquidity that moves markets. The movement of liquidity, guys. And you have to be looking 18 months out. That's exactly what I'm doing with the website, is I'm looking out ahead, checking what's present, and seeing how things are moving and rotating in terms of liquidity, the movement of liquidity. That's our ratios, if you want to know. It says, Druck learned from Soros that when you see it, bet big. He also humorously remarks that Soros spent 10% the amount of time working than him and still outperformed. That's not what I learned from George Soros. But I learned something incredibly valuable, and that is when you see it, to bet big. So what I had told you was already evolving. He totally cemented it. I know we got a bunch of golfers in the room tonight. For those who follow baseball, I had a higher batting average. Soros had a much bigger slugging percentage. When I took over Quantum, I was running Quantum, and however you pronounce that. He was running his personal account, which is about the size of an institution back then, by the way. And he was focusing 90% of his time on philanthropy and not really working day to day. In fact, a lot of the time he wasn't even around. And I'd say 90% of the ideas he was using came from me. And it was very insightful, and I'm a competitive person. Frankly, embarrassing that in his personal account, working about 10% of the time, he continued to beat Duckenmiller and Quantum while I was managing money. And again, it's because he was taking my ideas and he just had more guts. He was betting more money with my ideas than I was. So that's what he says there. It says, when the facts change, you have to be able to change your mind. But you know what? I've thought a lot of things when I'm managing money with great, great conviction. And a lot of times I'm wrong. And when you're betting the ranch and the circumstances change, you have to change. And that's how I've always managed money. He says, after losing $3 billion on tech stocks during the 2000 bubble, Druck famously said, I didn't learn anything. I already knew I wasn't supposed to do that. So let's go into how he lost this money. It says, in 1999, after Yahoo and America Online had already gone up like tenfold, I got the bright idea at Soros to short internet stocks. And I put 200 million in them in about February. And by mid-March, the 200 million short had lost 600 million on, gotten completely beat up, and was down like 15% on the year. And I was very proud of the fact that I'd never had a down year. And I thought, well, I'm finished. So the next thing that happens is I can't remember whether I went to Silicon Valley or talked to some 22-year-old Asperger. But whoever it was, they convinced me about this new tech boom that was going to take place. So I went and hired a couple of gunslingers because we only knew about IBM and Hewlett-Packard. I needed Veritas and VeriSign. I wanted the sixth. So we hired this guy, and we end up on the year. We had been down 15, and we ended up like 35% on the year, and the NASDAQ gone up 400%. So like around March, I could feel it coming. I just had to play. I couldn't help myself. And 3 times during the same week, I say, don't do it, don't do it. Anyway, I pick up the phone finally. I think I missed the top by an hour. About $6 billion worth of tech stocks, and in 6 weeks I had left Soros, and I had lost $3 billion in that one play. You asked me what I learned. I didn't learn anything. I already knew that I wasn't supposed to do that. I was just an emotional basket case and couldn't help myself. So maybe I learned not to do it again, but I already knew that. So yeah, he FOMO'd in just like some other people. It impacts everybody. It says, what does Druck look for in money managers? Passion, ability to manage bear markets, humility, and open-mindedness, integrity. Number 1, passion. I mentioned earlier I was passionate about the business. The problem with the business, if you're not passionate, it is so invigorating to certain individuals, they're going to work 24/7, and you're competing against them. So every time you buy something, one of them is selling it. So you're with one of the lazy people, or one of the people that are just doing it for the money. You're going to get run over by those people. The other characteristic I like to look for in money manager is when I look at their record, I immediately go to the bear markets and see how they did, particularly given of the 5-year outlook I've given. I want to make sure I've got a money manager who knows how to make money and manage money in turbulent times and not just in bull markets. The other thing I look for, Kenny, is open-mindedness and humility. I have never interviewed a money manager who told you he'd never make a mistake. And a lot of them do, who didn't stink. Every great money manager I've ever met, all they want to talk about is their mistakes. There are great humility there. But then obviously integrity, because passion without integrity leads to jail. So if you want someone who is absolutely obsessed with the business and obsessed with winning, they're not in it for the money, they're in it for the winning. You better have somebody with integrity. So there's that, and the end of that thread for Stanley Druckenmiller. So coming on down, it says the real M2 money stock deflated with CPI has reached minus 7.9%. All previous readings below minus 3.5 or lower have coincided with the recession. None of these previous readings were preceded by the historic unprecedented M2 expansion following COVID. So obviously, yeah, we see so we see a big move lower in the money supply here, but that's obviously on the back of a very large expansion that we've never seen in history. So interesting times are ahead of us, and I do think that we could potentially see a recession. This is the 1 ounce American silver eagle coin acting like a collectible bullion piece. Looks like the retail market is again squeezed to greater than $40 an ounce. That's a huge percent premium for American eagles. It's coming on down. It says magnificent takeoff platform morphing into existence for gold. And we just have a downtrend line that we've broken to the upside here in 2023, $20.60 there. So that's good. That's looking solid for gold. It says if you're worried about inflation, you do not want this to get out of the box to the upside. This is U.S. gasoline, where we could break to the upside here. We'll find out. It says primary energy consumption expected to decline minus 15% in developed countries by 2050, and an increase of 35% in emerging countries here. And this is hard to believe, in my opinion. It says primary energy consumption expected to decline minus 15% in developed countries by 2050, and an increase in 35%. If we're going to continue to grow, at least population-wise, I don't know how that's going to be possible. I mean, maybe things get more efficient. And the per capita use, but I don't know if I believe that. But that's what it shows us, at least in this chart here. It says Hughes correct. Also, gold's total cost of production is up nearly 40x since 1970. Amazing how energy and the cost of goods, commodities, tend to be the floor of the market price. The economy is based on energy economics, unless we believe in the energy tooth fairy. But what this is the gold price, and this is the cost curve, the cost curve of the actual cost to produce gold. The gold cost curve right now is $15.50. So it says for 50 years, the price of gold has been extremely volatile due to an increase in speculation. The red bars costs represent the estimated cost of production. Thus, the gold price always bounces off these levels. And this is the floor that keeps continuing to move up as ore grades and the cost of energy and inflation and the cost to mine it out of the ground goes up. This is also why the miners do not make as much money as like a royalty company. A royalty company gets a percentage of the total cost of what is sold. The miners get the margin, and if the cost is here, they make money when this moves up in the short time frame, but then they lose money as this bounces back to the cost curve. This one's a simple relationship for investors to remember. It says the falling USD, silver outperforms gold. A rising USD, gold outperforms silver. And what he's got here is the DXY. The DXY is the gold, and then the bars of green and red is silver to gold ratio. And whenever the DXY goes up, you can see the ratio falls. Gold outperforms. Right now, it looks like that we've got a falling DXY, and we could see the ratio where silver outperforms gold. So keep that in mind for that. It says, how transitory is inflation? It says an inflation jump to 4% is often temporary, but when inflation crosses 6%, it proceeds to higher levels over 80% of the time. When inflation crosses 8%, reverting to 2% usually takes 7 to 22 years, with a median of over 13 years. So we've got a lot of work to cut out for us if we're going to revert back to 2%, which usually takes on median 13 years. This is Powell's curve plunges to new lows, flashing U.S. recession warning. Research from Fed has argued that comparing forward rate on Treasury bills 18 months from now with current yield on 3-month bill was most reliable bond market signal of an imminent economic contraction. And right now we are way down there. So it's probably a high likelihood that we are going to see a recession and an economic contraction. I did do a video with Casper, or Casper did a video with me. Margin of safety is one of the most important concepts for investors to understand. The term was popularized by Ben Graham and is often used by top investors such as Pabry and Buffett. So margin of safety is basically you've got the intrinsic value of the company increasing over time. They have a margin of safety, and this is the cycle that they're buying it in the buy zone based off of the business cycle and the liquidity flows in the market that Stanley Druckenmiller was talking about. Here's a couple of quotes. He says, I want a company that's simple. They don't have to make 7 brilliant decisions every 6 months to keep going. It says, if you're not aggressive, you're not going to make money. And if you're not defensive, you're not going to keep money. Ray Dalio. Here's the gold chart. We've broken out of the top here, and we'll probably consolidate for a little bit on top before moving higher. So that's cool. This one here says, here is how the analog overlay of the current advancing phase for gold price is looking versus its advancing phase in the 1970s. The timing of the ultimate cycle high is expected between 2027 and 2028, which is supported by other analysis. And that could be the cycle high. We've got a long way to move higher in terms of multiples. It says, an ability to detach yourself from the crowd. I don't know to what extent that's innate or to what extent that's learned, but that's a quality you need, is to separate and detach yourself from the crowd. And that's what we've got for today, guys. So hopefully you guys enjoyed the clip. Definitely, if you need some help, check out the website or join the channel here. Click subscribe, give me a thumb up for the content, and we'll catch you guys later. This is Finding Value.